Hello and welcome to part 6 of Trading Commodities, brought to you by Option Hotline. I am Keith Harwood, and today I'm going to talk about commodity option skew. It is important when driving a option-based strategy to incorporate the skew in these markets. Now, before we get into the specifics, let's do the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please, once again, just take a moment to read through this, and then we will get into the content. All right. Hopefully you had a chance to get through all of that, and now we'll talk about me again. So, commodity skew. So when I went through my trading as a market maker and proprietary trader, a lot of my focus was on being delta neutral. So that meant I had to make my money off of other elements of the marketplace. Skew was a big part of that, and then all the other option Greeks. Really developed a lot of focus on skew when I was trading gold and silver as a market maker and proprietary trader there. So that's really where there was a lot of focus and really money to be made. And then we started really getting into what's going on with that skew with oil and things as we started going through that with the hedge fund, because that was driven a lot by hedging activity by producers, as I mentioned last time. So there's a lot there in skew, and there's a lot of money to be made actually on skew if you know how to leverage what the marketplace is giving you. So that's what I focus on today. I'm going to give you a very simple introduction to options for those of you that are a little behind on that, since we haven't talked about options at all here. I don't want to just glaze that over. Then we'll talk about some price distributions, how that impacts option skew, and then specifically let's talk about commodity skew. So let's get straight into it with an introduction to options. I just want to give you guys a basic definition here and give you, and then I'll give you a payout look next, so you have an understanding of what an option does. Okay. So a future requires the buyer to buy a security or asset at an agreed upon price on a specified date in the future. So when you're trading a future on a commodity, you're saying that whether the price of this asset goes up or down, I'm buying, and that's the price I'm buying at. So you've already set your full contract. 3 months from today, I am buying crude oil for $72. Okay, that's it. Now, you can sell out that future. You don't have to hold it to expiration, but you can exercise it early. You have a future date, and you can't reject that trade after all. You can't say after the fact, like, well, the price went down, I don't really want to pay 72. No, you have to. Options give you the right but not the obligation to buy that security or financial asset at an agreed upon price on or before a certain day. So now let's say that I was deciding whether I wanted to pay $72 for an oil future, or I said, I just want to hedge my risk in case it goes above 75. Like if it comes down, I'm cool. I'd rather just buy it for the future price. But if it goes above 75, I don't want to have to worry about this and end up paying 90 or 100. Okay, once you say, okay, I'm going to buy a $75 call rather than a future for 72. And if the market rallies to 90, I'm protected. But if the market falls off, I can now buy my future for a cheaper price. The general rule of thumb is that if I'm bullish, I'm looking to buy call options. And if I'm bearish, I'm looking to buy put options. A bull play would be to sell put options, and a bear play would be to sell call options. But generally speaking, the whole goal of that call option buyer is to make money on an increase in value. It doesn't always work that way. I want to be clear on that, because there are other nuances, specifically skew and implied volatility levels and everything else, that mean that I can buy a call, have the price go up, and not make money. Let's look at a specific example. So if, let's say, I'm not talking about the term to expiration or anything else here. Just what's that call worth if I buy it for, if I buy a $100 call for $5 and we get to expiration, what's it worth? What's my P&L? Well, if I paid $5 and we settle right at 100, I lose $5. If we go to 102, I lose $3 because it's worth 2 and I paid 5. So you can see that it's a protective element if we go higher, and I have max loss if we go lower. So if I'm buying calls for leverage, I have to buy more than one. But if I'm buying them for defined risk, that's a benefit there. So I can add extra units potentially. I can buy more than one call, and that's where I get my leverage. Or at a minimum, I get defined risk when I buy an option. On the put side, it's just the inverse of the call. If the price goes down, I am short below the strike. It's key to remember that if the option delivers the asset, that I either want to sell the option or sell the asset when I'm done. Because personally, I'm not interested in getting a bunch of barrels of oil delivered to my house. Okay? A lot of the stuff I do is focused on USO and GLD for this ease of access. But I still don't want to necessarily sit around all of the time, being long lots of shares of gold, GLD, or short a bunch of USO or anything in between. I would rather move to the next options trade. So remembering that, I think, is crucial as you start getting used to options. It's generally recommended to exit the options position prior to expiration. Let's talk about the market distribution, because this is where the skew kicks in, right? The stock market and the options models assume a normal distribution. So it says that up and down moves are equally likely and have equal magnitudes. Well, with the stock market, we tend to see that it's more likely to go up, but the tail risk is to the downside. So that means that when the market goes down, it can get real ugly real fast. It's hard for the market to get real ugly to the upside. It can happen in individual equities. So, stock gets taken over or has positive FDA news or good earnings or whatever else that drives a big gap to the upside. But generally speaking, the normal skew, no skew, doesn't apply to financial markets. It's a negatively skewed market. And so we create the skew of the options market to make up for that. I'll give you a graph of that in just a moment. First, I want to talk about commodity market distributions. Why do people buy precious metals or oil? What's the panic trade? Because that determines the skew, okay? Is the panic trade buying gold or selling gold? Usually the panic and the exuberant and the big move trade, the tail trade, is to the upside in precious metals. Recently we've had a couple of tail down moves, but generally, over the long run, it's the opposite of an equity skew. Oil, it can be either way. When the market's collapsing, it's just like an equity. When the market's rallying because of something like a hurricane or war in the Middle East, panic moves to the upside. So you don't always have the same skew. You have to know what the panic trade is, because the panic trade determines the distribution. In equity markets, this is the distribution because the panic trade tends to be the downside. Gold, this tends to be the distribution because the panic tends to be the upside. In a balanced market, this would be the distribution. If we're worried about massive upside move because of war, this is the distribution for oil. If we're worried about massive downside move because of an oversupplied scenario, this would be the oil distribution. So that then gets priced out in the options markets via the skew of the various strikes. So option pricing models, as I mentioned, assume a normal distribution. It's not real world. There's a lot of real of just things that aren't real when we apply them in an options model. We assume that there's no gap risk and all these other things that just can't actually. The reason we make those assumptions is because it makes the model much more efficient to run, and then we have to understand them and then account for them. So we account for them using a skewed volatility. Instead of setting all the strikes at the same volatility, we modify the skew up and down so that different strikes have different volatility. So that's what this is right here, the skewed volatility to indicate where the panic move is most likely. So if we're worried that the panic move is to the downside, then puts will have higher implied volatility than calls. That's what we see in a traditional equity skew. So I just took a snapshot of some 6-month out options, the option skew. So, S&P's somewhere right around here, around that 2,900 and change level. You can see the lowest strikes are here above 3,000 in the 3,200 range. So the expectation is, if the market were to rally, volatility probably comes off and panic isn't there. If the market starts to collapse, this volatility could explode. That's what this market is telling us, is that if there's panic in the market, it's going to come to the downside, and that's where volatility is going to increase. If we get a rally, it's more likely to be slow, that negatively skewed distribution. Here's another way I can look at it just to give myself a perspective is how this market's been moving. So this right here, this is the market movement. This is the skew. It's just taking the volatility of the put minus the volatility of the call and dividing it by at the money. So it gives me a ratio. Okay, so if you can see the numbers here. If the 25 delta put is 14% and the 25 delta call is 9%, then that skew comes out at 0.51 because the at the money volatility is 10%. So it's just taking a normalized element and telling me how much fear there is in the market. When the skew is closer to 0 in the S&Ps, it means that there's not a lot of concern on the downside. When the skew is close to 1, it tells me that there's a lot of concern on the downside. So we saw, even here, the skew was getting really cheap relative to its norm. And then panic happened and it stayed relatively high for a while, and now it's starting to drift back lower, but it has ways to go potentially to replicate the January skew, which was kind of out of this world. Okay, so that's what we want to see here. Is this is just something that can give me a where we are in the range. I use this for trading my options and structuring my options trade. That's why it's important here. Let's look at it in GLD. That's the 0 line. So like I said, calls tend to be higher than puts. Okay? And here, the put is 2% less than the call on the 25 delta option. Even with us down at lows. That skews there. Puts are cheaper than calls. Because the expectation in these commodities is for the massive move, the scary move to go higher. When war breaks out, people could oftentimes buy gold and oil and other commodities. I'm not saying war is imminent, but that's one of those drivers that creates that skew. What about oil? Well, recently it's actually been more like an equity. Even when we were at these lows here in July of 2017, had more of an equity skew. This is partially driven by that hedging activity I mentioned. So oil at times should certainly have skew more like gold, where calls are more expensive than puts. But oftentimes it doesn't, because you have the producer selling calls and buying puts to hedge his production. The consumer is less inclined to hedge on average because they tend to shift consumption needs based upon the price. These oil producers only have one source of income. The price of oil matters much more to them. Okay, so that's where a lot of this big hedging activity can come in and create a more equity-like skew. It's probably likely that we had some hedging going on here in this period, on top of the fact that people were concerned about what was going on in equity land. And here, as we get higher and calls get a little more expensive, maybe it tells us a little bit of something about what's going on in the oil world, that maybe there aren't as many call sellers anymore. What does that mean? How do I structure my options trade now? We're above those moving averages. Talked about that last time. Calls are kind of starting to get a little bit expensive relative to puts. Is the momentum still there? What options trade do I want in order to leverage my technical signal? That's what I spend all my time working on. I can't teach that in a short period of time, but over time, I hope that you guys can learn that if you sign up for that CoreCom program. So if you sign up for my commodities programs, you're going to start to get a sense of how I structure these trades and why, and then be able to learn how to do this sort of stuff yourself. Okay? What's the normal skew expectation for GLD? So a put skew is when the put vol is higher than the call vol. Call skew would be call implied volatility is higher than put implied volatility. Do I expect no skew, or do I really just have no expectation? Well, I expect the call skew. Remember, what we saw in gold and what we expect in gold is that calls will have higher implied volatility than puts, because the panic move in gold is traditionally to the upside. All right, guys. Next time we're going to talk about position sizing and incorporating options into the trade.